Hey everyone, I'm your host Tom Shaughnessy, and welcome back to Chain Reaction, a research-driven podcast that's a part of Delphi Digital. If you're not on Delphi's research portal, you're missing out on the critical analysis read by the top minds in the crypto space, so be sure to check it out. One quick housekeeping item: nothing said on this podcast is a solicitation to buy or sell any security or token, or to make any financial decisions. Also, all advertisements and podcast sponsors are strictly for informational purposes only and not endorsements of any products or services. I may personally hold tokens mentioned on the podcast, and you can view our show notes below for our complete disclosures. Hey guys, I want to tell you about our new podcast sponsor, Alto IRA. Alto IRA is the leading platform for individuals to invest in alternative assets with IRA savings. These assets include real estate, equity crowdfunding, and yes, cryptocurrency, including Bitcoin. The platform's cost-effective, and it's a hassle-free way to connect IRAs to investments previously hidden from many investors. Visit altoira.com/chainreaction for more information. It's linked in the show notes below. With that, let's jump into the episode. Hey everyone, welcome back to the podcast. Today I'm thrilled to have a friend on, Hassan, who is a VP of Portfolio Management at the crypto fund Arca, ARCA. Hassan, how's it going?
Good, man. Good. It's been a long time coming considering how much I talked to you.
Yeah, man. I feel like we should just get our Telegram group on here and we could have a day-long podcast.
It would be fun.
So it's been a crazy week or two with yield farming, man.
Yeah.
You've been attacking this or what?
Have I been? No. I mean, for us, for Arca, our strategy would be to kind of, had I known Comp was going to list on Coinbase, I would have just bought it all in the first 3 days that it was being mined before the announcement listing. But like Comp, the way the liquidity mining works, it's a big boy trade at this point. You need, considering the pool size and stuff, you probably need to throw 10 million of loose capital in there. And we use our balance sheet a lot, so it's just not a trade for Arca.
Yeah, that's totally fair. Well, before we dive into everything going on with yield farming and everything else, why don't you give us some background on you and where you came from, and then we'll go into Arca and what the fund's about.
Yeah, no problem. So I was a lawyer. I was doing cross-border M&A for KPMG. Graduated in 2005, so I'm dating myself here, from Northwestern. And
a lot of experience, man.
Yeah. That's I'm ancient in crypto years. But yeah, so I was working at KPMG in the New York office doing cross-border M&A for about 5 or 6 years. Moved back to LA because I'm from here originally, and then started working with a lot of private equity clients, doing the same kind of stuff, like structuring their cross-border sales and acquisitions. And then I became a CFA and got way more into the finance aspect of my job. And when I was all done paying my student loans off, the $1 million of student debt that I had accrued when I was done.
Oh my God,
off,
man!
We're in a bubble.
Yep. I'm with you there.
I jumped ship over to Arca. I'd actually interviewed with one of Arca's founders at Guggenheim earlier, and then when they started Arca, I came on board.
I like how you brushed over going from being a lawyer to a CFA like it was a weekend.
Yeah, no, I think I obviously have the utmost respect for lawyers and the law in general, but I thought it's not for me. Like I like action. I'm a fast-paced person, and I'm constantly thinking. And the law is interesting in its own right, but it's kind of just monotonous and a lot of paperwork. And you do add value, but the value that you add is very, very subjective to whom your clients are. Especially as a transactional attorney, like I was pushing a lot of paper. It was the same thing over and over again. And it's nice because you're making pretty good money. But you're also, it's just, that wasn't exciting for me, and I couldn't do it anymore. And the second that I didn't have to do it anymore monetarily, I was able to get out. So I'm really thankful for that. But yeah,
so
in crypto, go ahead.
So the day the loans were paid off, 2 weeks notice.
literally like that. I got my bonus. I got my last bonus and paid everything off, and then was like, okay, now I'm like free.
That's
So
so for those no, that's amazing. I mean, for those that I mean, I think everyone's, pretty familiar with the law in some parts, but not like the level of depth that you were going to. I mean, what exactly cross-border M&A? I mean, what's like does one of those deals take a week, a year? Like what level of depth were you going to? What's that
it
like?
depends. Yeah, it depends on the assets. It depends on like target size and like how structured the acquisition is going to be. But at a high level, it's doing things like this. It's like, okay, you're going to buy a company for $100 million. The company's based in Germany, and you're a U.S. company. How are you going to buy the company? Are you going to do it with leverage? Are you going to do it with debt? Are you going to issue stock? And then let's say you've taken on debt and you want to buy the company. Where should you be kind of monetizing that debt? What I mean is, like, you're going to buy this company and you get like a 30% interest deduction in Germany and a 10% interest deduction in the United States, let's say. You actually want to be buying that company from Germany, because when you're paying your interest expense, it's like a bigger tax benefit with the higher rate. So things like that. I mean, and then afterwards, after you bought the company, like, what assets do you need and what don't you need? Because you want to be stripping out all of your debt assets that you don't need to sell them and pay off your debt. And then, like, looking at things like market analysis and how big of a share for your various product or whatever you're selling or buying. Like, now after you've acquired this company, how big of a market share do you have in that jurisdiction, and can you push price around? And can you like extract value now that you're the biggest player in that space? Things like that.
It's crazy how you went from dealing with the giants of the world to dealing with, the smallest projects in crypto.
Yeah, now I'm like looking
Yeah.
at like 3 million micro cap tokens and
Yeah.
thinking if I can get 3x on them. But yeah,
Literally.
it's interesting. It's
So
interesting.
how so Arca, before we go back to your background, Arca crypto fund, can you just give the quick overview on your focus of the fund?
Yeah. So Arca, maybe background first for Arca. Arca is a digital asset hedge fund. We trade more or less everything based on liquidity and sizing and risk reward. We trade literally every size token. We look at risk in four ways. We have our market beta risk, our asymmetric upside, which is like our 10 to 50 xers, and then we have catalyst trades where you're playing events. And we do some long short and arbitrage, and we do some derivatives to like hedge the book. I trade some derivatives for us, as well as manage a portion of the portfolio. And I look at our asymmetric, like I source ideas and look for asymmetric upside bets in terms of projects. And then, I never spent time on Wall Street trading derivatives, so we're not a derivatives desk, but like we do use derivatives to hedge the book in various ways, depending on portfolio construction and what we think the outcome for Bitcoin will be in a month or a week, depending on how long we're going to be in some of these lower cap tokens.
Got it. Okay, cool. Good stuff. So we have Arca, we have you, but so going back to you for a second, how much of your legal career do you think you use in crypto? Like, is it your maybe like attention to detail like that you bring over, or like are you actually digging into the legalities of things within the space, or is it kind of lost? What's your take there?
Yeah, I think in terms of that, like, one thing law school teaches you how to do is think think from both sides. Like, don't just see your side, see the other opponent's side, and try to front run what their rebuttals will be. And this actually helps a lot in crypto and in finance in general, because if I'm a buyer and I think I know where the sellers will be trying to get prints on it. And if I buy it first, I could sell it back before that. Or, I mean, there's just a million ways to think about it, like where I think buy or sell pressure will be, or what I think will happen under various, scenario analysis outcomes and things like that. So it does help. It's not exactly one-to-one correlation, but I mean, it helps you how to think, and it helps you in your life broadly. But yeah, man, finance and crypto is a lot different than M&A.
Yeah,
So.
no. Well, I mean, everyone in crypto, when they take on a trade, it's blinders on, man. I feel like nobody looks at the other side of these trades most of the time.
Yeah, no, it's, I mean, one thing we do is we always have a risk reward and an exit point in mind before we get into the trade. And then one thing our CIO will do is, he'll say, okay, if you get into this trade right here, and tomorrow token's down 25%. Do you buy more? Yes or no? And if the answer is no, then you probably shouldn't be getting in the trade unless there's exigent circumstances as to why it's dropped and you don't have those answers. But the point is like, I mean, you do this for a living too. These tokens, they move 15% a day, and that's a nothing. That could be a normal day based on, volatility underlying in beta. So you really have to be comfortable buying a token, watching it go down 25% on really nothing.
Nothing.
And then being comfortable to be like, I believe in the trade, I believe in my idea, and I'm buying more here. And it happens all the time, and you kind of just get used to it. I mean, we don't even talk about it anymore. It's just assumed that if you're in a trade, which is going to be a month or 2 months, and it drops 25%, you have to be willing to buy more, because if it's a good trade, you will be willing to buy more. We size things based on conviction.
The rules you bring up are pretty, like, I don't think of, like, it's great to have set rules, right? Like, it seems so clean, but it, like, the space changes so much. Like, do those rules stand up if there's a change to the project itself? Because these things change like overnight.
No, everything, like, you're right. We have I like to call it we do have rules-based trading, but that rules-based has bands, right? So if it's, and a lot of it's based on feel and market structure and, market terms, and how, like, honestly, like, how big is Bitcoin volatile or is Bitcoin not volatile? You generally want to be trading alts when Bitcoin is not volatile, right? Short Bitcoin vol equals alt season. And so it really depends. And there is an element of human touch and feel. Like, how do you feel like the market's going to adjust to this change in, like, tokenomics for the project or something like that? So yeah, it's not 100% rules based, but it helps you have a framework, which is the most important thing, I think, in this space, having a framework before you. But.
Yeah, no, you definitely need one of those. So let's start at the beginning. So sourcing ideas for a fund is tough, right? Like, I feel like, at Delphi, we have, 10 guys, everyone's out there, everyone has their different types of inbounds on where they find deal or where they find projects to cover, things like that. How do you guys handle sourcing for Arca?
So, like, we'll talk generally. Like, so for the catalyst bucket, that's kind of, those are easier to find, right? Because, like, for some of these large cap, mid cap tokens, they're out there on Twitter or Discord or Reddit or what, shilling their like network upgrade or shilling their mainnet. So those are pretty easy to find. Where it gets harder is finding a under the radar project, which either does have a catalyst or, it's like a sub $100 million market cap, sub $50 million market cap, where you think that you can get outsized returns either based on a catalyst upcoming, or it's just a good trade or a good investment. So, like, for like bigger, larger cap tokens, the catalysts are pretty easy to come by. But for the stuff I'm looking at, a lot of it is just like being in different Telegram groups, being online a lot, talking to a lot of other analysts in the space, just being plugged in is what I want to say. Like, you really have to stay on top of it. I try to look at like 6 to 7 coins a day, just at a high level. And then I'll drill down into the ones that look more or seem more interesting. And it's more interesting to me based on various factors. And the primary one is like optionality. I think optionality in crypto is the most important thing you can have as a buyer, right? You want that optionality because, like you said, the space changes so fast, the token prices move so much, and the information that you have, hopefully you have all the information all the time, but that's not always the case. And you always want to preserve optionality because you can decide whether it's a short, medium, or long-term trade. You could take a piece off the table and free roll with the rest. You can get bigger if you want, if you're getting more convictions, you talk to the team more and you understand the roadmap and the development more and the community's growing. So generally, long story short is like, you just want to be, I want to be sourcing ideas from my network of people, and I want to be in a lot of chat groups and understanding where people are looking at ideas, AMAs, things like that.
Yeah, that's a lot. I like it, especially 6 or 7 a day.
Yeah, I'm probably on Telegram, bro, like 16 hours a day. Like, and you know this because I'm talking to you about 5 of them. So,
yeah, man, I enjoy our 3 a.m. chats.
Yeah,
but so Hassan, you guys are a very institutional, buttons up hedge fund and crypto. Like Jeff, your CIO comes from Wall Street. Katie, like your team is solid,
VC.
right? But
Yeah.
how do you, so like, what's the turnaround time on a small project? Like, let's say you find a project that has $1 million market cap, it checks all your boxes, and everyone, you presume everyone's going to agree on the Arca side. How long does it take from you finding it to you guys investing in it?
So for smaller ones like that, where it's like, sub $5 million market cap, I don't mind. Like, you've got to like 4, 5, 6x that thing for it to be worth putting the money in the first place, right?
Yeah.
So I don't. We take on the smaller ones, we take a deeper dive in the sense that like I will. First of all the ideas have to be brought to investment committee for micro caps and mid cap, smaller trades. So I have to present it, and I have to have in that presentation a full analysis of what I think it's worth, why I think it will be worth what I think it will be worth. If it's a 5x, a time horizon on it, things that will impact the time horizon, a competitive analysis of like landscape of competitors and things that other like comps basically. And, I could do that if I find something that I really, really like. I could do that in, probably like a day or two of like putting it all together and presenting it. Now, like convincing, Katie and Jeff and the guys that, Wes and Sasha, like that it's a good trade, that may take a little longer. But in general, I think one of the reasons we've been successful is because our CIO gives us a lot of rope. Like if you can produce returns and you make good investments, you get more rope. So even if everyone on the team doesn't agree with me, we can we'll just size down the position and it'll be like my baby. And, then it's my head too, right? But like I'm willing to, for some of the stuff, you have to have the conviction to kind of put the money in. And it's also, I think it's actually really good that the team disagrees. Like, I can't remember a single investment where everyone was on board all the time. And
that would be scarier.
Yeah, exactly. Like you want people to disagree. You want people to fight. You want people to bicker, and you want to get those ideas hashed out, and you want to address those ideas. And if you're in it, as the project moves along, you want to come back and revert and see like what worked out, what didn't, and why was I right or wrong. So, long story short, like probably a day or two if I really like it. And with some of these micro caps, if it moves 25, 40%, 50%, even 100%, if it's a really good idea, you're not late. You're not late.
Agreed.
You know what I mean? Like
you have plenty of time if it's a good idea.
Yeah. And like you're seeing it play out, right? You know what I mean? There's just some of these like, I think Len's up 800% in the year. Like Bancor's up, I think 700% in the last month and a half. Like,
Insane.
Rune is up 400% in the past month. Like you're not really late. Like if you think you're late, you're probably, if you think you're late, you probably are late. You know what I mean? If you don't really believe that it can keep growing. So, and then, it's not like there's no formula, but you do this enough,
That's fair. And, it's obvious, but you guys are a fund, you're here to make money. But I mean, you're also in a new space where the tech is exciting. You get attracted to ideas and plays that you like. How often are these trades for you? And how often are they trades, but hey, I really want to see this project work out. I really like this. I hope, like, I'm trying to determine the level of where something begins as a trade and turns into something you really want to see come into fruition. But that might be more on the VC side of things anyway. So it might not be in the right wheelhouse.
Yeah, no, I mean, I think, so we have a blend, right? Like and it's kind of based on like liquidity and return. So like we have a few trades where we're going to be in it for a year. And that's for a few reasons. One, structurally, like that's how the trade works. Like an example is like long short ETH, right? So for that, like our lockup on the ETH shares is a year. So it doesn't really matter what we think, we're stuck for a year. That's why. So like for a trade like that, like the best thing for us is we're just trying to capture the premium, what we think the premium will be in a year. So we're short ETH and we're long ETH shares, and in a year we'll know where that plays out. Other trades that maybe don't last a year, like that are projects that we like, we know for some of these things, if you're really early, it's going to take at least 6-7 months for the team and the development and the test net and the code audit and finding bugs and the education of the market and the secondary market to develop, like those are probably also a year. It's very rare that you get something where you're going to 10x in a month, right? I mean, it's totally possible. It's totally possible. Like this is crypto. Literally anything can happen. You have to be prepared for it. But if you're investing in something on the ground floor as a project or a micro cap or mid cap, unless something is very wrong structurally with the token, if there's no development or if there's no growth in the platform or whatever, it shouldn't be 10xing in a month. And if it is, that's kind of a sign that something smells or
something sketchy.
Something sketchy. It may be time to take a print on that if it's 10xing on no news. So it's tough.
So Hassan, walk me through the ETHE trade, because it's kind of it's interesting. I mean, like this seems like very straightforward. You could allocate a lot more money to this versus the micro caps. It's all, you're basically locked in for a year. But on the flip side, on something that's, $1, $5 or $10 million market cap, you're going to have to spend weeks of dedicated time understanding and tracking this. But obviously the payoff could be a lot more. Like, I guess walk me through the ETHE trade. And I guess the second question is kind of comparing that to the potential on the micro cap side of things.
Yeah. So so for ETHE, it's been a buzz on Twitter the past few weeks. We've been in the trade, full disclosure, for quite some time now. We're not like unlocking anytime soon, but we've been in the trade for a while. So basically, we noticed that in June of I believe it was June of 2019. In June of 2019, ETHE started trading. It started trading publicly via OTC. And recently, I think like 5 months ago, we noticed probably the beginning of the year, the premium was just insane, like 5-6x. So we just borrowed ETH from a counterparty. We got good terms on the ETH we borrowed, and we contributed the ETH in kind to the Grayscale Trust. And so now we're short ETH a certain amount, and we're long ETHE. And really, our downside, the risk return profile of the trade is, so long as my return on ETHE exceeds my cost of borrowing ETH, then I'm in the money. And the return on ETHE is a function of the premium when the unlock ends. So your downside really in that, like if ETH goes to zero, not saying that it will, I hope to God it doesn't for all of us, but if ETH goes to zero, I'm basically just going to have to pay like the interest on what I've borrowed, right? Well, let's say ETH goes to $1. So my dollar cost on that would be like, I think 10% interest. So 0.1, right? And if ETH goes to zero, my ETHE trade probably also goes to zero. So really at the end of the day, my downside is only the amount I've borrowed, or the cost to borrow. And, there's some idiosyncratic risks, like what if Grayscale allows for redemptions? Then theoretically ETHE could trade on the market at a discount to NAV. Theoretically, people have been talking about this a while. We don't see that happening.
So Hassan, basically you guys borrowed ETH and you obviously pay an interest rate for that. You contributed in kind to Grayscale, and basically those shares are now worth, you can now exit at the premium. Those are now worth, hopefully if the premium holds up, and then you net the difference minus the fees to borrow.
Yep. Yeah. So the formula is like just ending premium minus cost to borrow. That's our return.
So easy compared to some of these token econ models on the smaller side of things.
Yeah. Yeah. And everyone, like crypto Twitter loves to just look at price. This ETHE ETH trade, like this thing is coming down. The premium was, I think, 1,000. It was like a 10x NAV last week. There was some unlocks on the 21st. I think there's unlocks through August and September. The flow will 8x by that point. We're fully aware that this thing is coming down.
But it's not just the premium though, right? Like you earn more if ETH's price goes up times whatever that premium is as well, right?
Yeah, but I'm also short ETH.
Got it. Okay.
Yeah, so for me, for us, it's just a premium capture trade. I know funds that just ride the ETHE long and don't hedge it at all, and that's fine too. I mean that's great. Like you would have 10x'd had you done that last year, right? And you'd not be short ETH, you would have 10x'd, which is a fabulous trade. But like, for us, it's like managing the risk, just long, short makes a little more sense for us, especially based on where we think the premium will be.
That's awesome. Hey guys, I want to tell you about our new podcast sponsor, Alto IRA. Alto IRA is the leading platform for individuals to invest in alternative assets with IRA savings. These assets include real estate, equity crowdfunding, and yes, cryptocurrency, including Bitcoin. The platform's cost-effective, and it's a hassle-free way to connect IRAs to investments previously hidden from many investors. Visit altoira.com/chainreaction for more information. It's linked in the show notes below. All right, so that's on the big side of things. ETH, second largest asset, really straightforward trade. Let's go over to yield farming, liquidity mining. Basically, you have a rush of people trying to get involved in these early money market lending, borrowing platforms so that they can either supply assets or borrow them. And in return, they're earning a yield or paying a yield. And they're also earning the protocol's native token. So in compounds, for instance, on Compound, you have like 2,800 comp a day distributed among lenders and borrowers. And it's, driving the lending rates and everything kind of crazy on this thing. What are your thoughts on yield farming, Hassan? It seems kind of crazy right now.
I mean, I think I have a lot of thoughts on this. I think it's a really amazing. I'm happy for Compound and the success the tokens had. It's obviously on Coinbase right now. It's been like 3 days. I think that's like the fastest listing ever. I don't know how that happened. But yeah, look, like I think Compound is super interesting because originally, like it's based on the pool size, right? So when there's 2,800 a day, if Tether is generating the most interest on the platform, or Tether is generating like 90% of the interest, then the Tether pool would get 90% of the comp that day, and then that 90% is split between borrowers and lenders. So originally, I think the Tether pools got to like well over 200 million on the supply and 150 million on the borrow. So Tether was just getting all accruing all the comp. And you really want to be on the borrowing side of that because you'd be a bigger portion of the pool. What happened was, I think Compound governance just changed the reserve ratio. So it actually reduced the amount of interest going to suppliers. And so what that did is, so suppliers stopped putting in Tether, borrowers stopped borrowing Tether. And now I think BAT and 0x are the ones that are have the biggest pools and are generating the most interest. I think like when I checked, BAT was like 30% to borrow it. And like, I think actually that's a little more dangerous, right? Because what everyone's doing on Compound, especially with the stable coins, was like, I put in USDC, I supply it, I borrow Tether against that, I take my Tether out, I sell my Tether for USDC, I bring that back into Compound, I borrow more Tether, I sell that. So you could get like 4x leverage on that on the stable coin. But now where you have an alt like BAT or 0x, which is dominating the amount of comp that will accrue to that pool, I think it gets a little more dangerous. And I think Compound has adjusted for this by like decreasing the loan to value or decreasing what you can borrow or how much you could get levered on it. But still, like for these alts, like it's one thing to lever up stablecoins. It's another thing to lever up alts. And, there's all types of games that, some of the bigger players can play with the BAT borrowers, assuming they're actually taking the BAT and selling it. But if they're just sitting in BAT, that's fine. But yeah, I mean, it's an interesting way to bootstrap liquidity. I think for Compound, they're monetizing their moat or goodwill they've built on the platform over some time. And there's been other liquidity farming or transaction mining, whatever you want to call it, platforms that have been launched. I think like Fcoin was one. I think Bitmax was another one, just like some exchange tokens, which I think CoinFlex was another one. And I think this is a more elegant solution because it's daily, like it's the same amount for 4 years. And with some of the other ones, it was massive upfront inflation. And so if you have it over 4 years, after year one, 50% of the total that can be mined is already gone. So if you like discount what years 2, 3, and 4 are worth and bring that back to present value with a crypto discount rate, it's not really worth it.
I'm with you there. The 4-year mark was genius because you basically on Compound, you incentivize people to stay.
Yeah. And like, and for Compound, like, it'll be a function of what pool is generating the most interest. That's the one we're going to lend to, and that's the one we're going to borrow from. And you can kind of arbitrage that and figure out like where it makes sense to be levered or if you're not levered. Just it's all a math problem. It's all a complex math problem that's changing every day, and you have to be on top of it to kind of farm efficiently, I think. Especially now with like Balancer and Curve coming out. Like this is the rage right now. You know how crypto works. It's a copycat game. First mover probably gets the most, but then there's plenty of value to be had by other protocols doing the same thing.
So Hassan, I have a bunch of questions for you here. Let's start at high level. So the comp token, I mean, multi-billion-dollar valuation on no liquidity. I mean, you guys are a fund. Like it's something that is, it looks like a screaming short, but on the flip side, us knowing crypto, you would never want to bet against exuberance in this market. What are you kind of thinking there?
Yeah, I mean, we think the same thing. We think like, first of all, you want to be looking where everyone is not looking. So everyone's talking about shorting comp and it's a bubble and this and that, and all of that may be true. All of that could totally be true. Like you may have seen comp's highest print at, I think Coinbase hit $400 today. I'm not sure how much volume was transacted up there, but it definitely hit $400. So you don't want to be, from our perspective, is you generally don't want to be short a token at launch just because you think it's going to go down, because the market will humble you and you're going to get liquidated sooner rather than later. There's irrational exuberance in crypto, like we always say on the desk, like there is no floor and there is no ceiling to this stuff. So you don't want to be the one that's stubborn. Now you could totally be hedged. Like if you're long comp on FTX and you're short comp on Coinbase or vice versa, like you could totally do that. But just taking a unilateral direction short in something that just launched, it's pretty scary, and you need a very big balance sheet to do it. And the other thing with comp that this is kind of like a negative thing is, I looked around trying to get the vesting and distribution schedule for comp, and I couldn't really, it couldn't really find it. I know how much is being distributed via liquidity mining, and I know that there's another, I think 5.8 million tokens out there. Like I think 2.4, the rumors are like 2.4 were liquid from early VCs, and like the team and equity holders have to have a 1-year lockup. But like I don't have anything telling me that. And so if you don't have that type of information, it's tough to take a short position or to be quite frank, even a long position. And so, we didn't trade comp really. We think there's other opportunities out there that will, from second order effects of crypto, like Balancer, although even that is getting expensive now. I checked this morning, it was like 14. Now it was like right before I came on the pod, it was 20. What is it now?
I mean, what are they? I mean, the diluted market cap is crazy. I mean, the circulating supply is low, but it's just a wild market cap.
Yeah. I mean, a lot of the theory, like for these trades, like if you're not doing the actual mining, a lot of the theory or the thesis behind the trade is you buy it first and then like, cause it's going to go up, a number go up. It's not a great thesis, but like crypto is momentum based. For us at Arca, like we try to pride ourselves on having a thesis that's more than number go up. And so it's tough to justify taking a position if you're not liquidity mining in these tokens, unless you're like a Momo guy or like a high frequency trade shop, which we're not. So
no, that makes a lot of sense. I mean, there's a lot of different liquidity mining avenues going on. You mentioned, we talked about comp, there's Balancer, Curve, Aave, like there's a bunch of them out there. I guess what people don't really talk about though is like how this ends or if it will end, right? So like, it's great to attract, potentially millions of people into the space, but like, where does the trade go bad? I mean, the most obvious is like comp's token price goes down, but what are the risks?
Yeah. So like with comp, it's actually a pretty, like we could take the stable coin. Like, let's say for comp, it's just a simple math problem for us. It was like, okay, like there's 3,000 comp distributed a day. The Tether pool is dominating 90% of the total interest. So that means the Tether pool gets 2,700. That means buyers and sellers or lenders and borrowers get 1,350 each. Okay. I can lever the borrow side 4x. So if I put in 4 million of USDC, I could borrow 3 million Tether. How much, and I'm paying like 15% on that Tether, how much comp does that get me based on my pool size? And then on the other side, I could be lending Tether too, but I can't be levering that side up. So in other words, what I'm trying to say is it's just, what is my net interest expense to earn comp? and how much am I going to be earning every day? And
Hassan, where's your tweet on this, man? You could have cleared up a lot of discussions on Twitter.
Oh God, yeah, I've been trying to stay off crypto Twitter, but like,
no, go on.
Yeah, no, it's just comp is a math problem. Like, what is my net interest expense to generate comp, and so therefore I know what my implied cost of comp is, right? Because it's all I'm paying, the interest that I'm paying for the comp that I'm earning, and then if comp's market price is above that, then I'm above break even. You do that trade all day. But what happens, obviously, and why I said it was a big boy trade, bringing it for full circle, is like you put in, let's say you have $10 million, you allocate $5 million to the supply, and you allocate $5 million to the borrow, and then you lever that up. That means I can get 16 million in borrow, right? And 5 million in 5 million in lending. That means I'm actually paying a lot of interest, and I have to figure out how that works. Like, now it shifts also, right? Like if I have 10 million in the pool on day one, and then big OTC shops get in there and start farming comp, all of a sudden I go from owning 10% of the pool to owning 0.1% of the pool. Is it still worth it there?
No, that's not. Fair.
Yeah,
and what's not. Nobody really talks about the benefit for having people compete to farm comp. What is the benefit to the world and the users? Is it just greater liquidity or lower rates? Like, what is the reason to try and attract people into these platforms?
Yeah, I think it's both, like bootstrapping liquidity, bootstrapping usage, and adoption. Like, I mean, like comp has had dude, I think like on June, there's a graphic somewhere, but like on June, I think 10th or 11th or 12th, there was $1 million of tether in the comp pool. At the peak, I think there was $250 million. And this is less than 2 weeks later. I think in a week, so
it's a hell of a drug.
It's a hell of a drug. But I think, what to dovetail that point there, I think there's like a reflexivity both ways, right? The second the comp token stops going up and it comes down, and you're falling under the break even, or you may not capture the value in the comp token, or there's something that happens where they say, like, you can't pay. Like, one of the theories that people have about comp is that the governance will choose to distribute a dividend out of reserves to the comp holders, right? That's a theory. Some analysts are talking about it. So let's say the opposite is true. Like, governance passes a proposal that comp will never pay a dividend to its holders out of the reserves. If that's the case, I can promise you that comp price is coming down. If that comp price comes down, it's the same thing. People are going to stop adding liquidity to the pools. The yields will come down. People will be less interested. So, like, this reflexivity works both ways. And right now, its number go up, and hopefully nothing happens that will turn that, change the narrative, and have the number go down. But it's just like reflexivity works both ways. Is the long and short of it. So we'll see what happens.
Do you think that users will stay on comp if that reflexivity goes the other way? Like, let's say comp gets buried. Like, do you think people will stay and actually use the platform? Or do you think that this thing will blow up as fast as it blew up?
That's a great question. I think that, look, like, if you're you're in the space, like, what's happening right now on comp is that a lot of OTC desks are farming that comp. A lot of OTC desks, like, we don't need to name names. We know who it is. These are guys dumping $40, $50 million of that 0x Tether. It's just sitting on their balance sheet anyway. And they're just, making, they're trying to get yield from it. They're monetizing that asset. And I would say that if comp goes down or reduces, I do see a lot of liquidity leaving the platform. But what this certainly has done is it has created a lifelong user that would not have otherwise been there because they didn't know what comp was. Maybe the OTC desks don't stay, because there's other ways to monetize their book or use their balance sheet. But there's definitely a lot of users who did not know what comp was that will now be on comp and use it. And I think that's good. I think that's a great way to increase your market awareness of your product and generate you've proven product market fit. And now you're getting value for that. You're adding customer base and users and increasing loans and all that stuff. But yeah, I definitely think if the price goes down, the pool size is coming down.
Yeah. And I mean, to your point, like there's some really complex risks though. Like if you do like a wild trade, and I'm winging this, so it might be wrong, but like if you lock your Bitcoin for like wrap Bitcoin, use that as collateral for ETH, lock the ETH for DAI, convert the DAI to like Tether or something on Curve, supply that to Compound. Like there's so many risk factors in here that are really honestly hard to figure out, and they change every day.
Yeah, I mean, and that's why, to be honest, like with Arca, like we don't have a position. I can say we did not like we're not in any of that trade for part of the reason the smart contract risk. We don't understand all the risks we need. We're not as smart on the risks as we need to be. We know what we don't know, and because we don't know it, we're not going to mess with it. For us, like an Arca trade would be to buy the comp token rather than and sell it into the listing rather than farm it, because we just don't know all the risks there. And yeah, I mean, like, look, like right now you can swap your stable coins on Curve all day, no problem. You could, but we are not, especially with the BZX tax and things like that. We know what we don't know. We know we have to stay away until we get a little smarter on it. But we're interesting. It's interesting to see it coming to fruition.
No, that's fair. And Hassan, what are you thinking though about like the longevity of farming itself? Like, do you think this is a short-term thing? Like it'll die out after Balancer and Compound and stuff? Or do you think that this is a long-term thing and we got, a year or two of this? I'm just trying to like...
I think, look, like, what's funny is like, this is liquidity mining, transaction mining, whatever you want to call it, is not new. It's not a new thing. It's a new wrapper on an old toy. Like this is more elegantly done. You know what I mean? This is a lot more elegantly done in the sense that like it's a slow distribution. Like a lot of the other exchanges or platforms that were utilizing transaction mining in the beginning, they were trying to bootstrap users from the jump, from initially. Compound had a platform, had a product market fit, had users, and they bootstrapped explosive growth. You know what I mean? So it's a little different. And for that reason, I think it's more elegantly done and has more staying power.
It's kind of crazy though. I mean, they did both though. Like they got the initial users and it's sustainable. I mean, sustainable with risks, but they kind of got both.
Yeah. But they built the product. Like Compound's been around since I think 2017, 2018. This is not an overnight success. It's not an overnight success. And that is what makes it different, is that they introduced a token to a platform which was already being used. And in a way, like people can say everything they want, like they're giving, like this is a way for VCs to cash out. This is a way to monetize equity value. This is a way to pay dividends out of the reserves, blah, blah. It's a way to generate cash flow from the product. Whatever you want to say, that can all be true. But it's also true that they had a product first, that product had found product market fit, and this was just a way to generate explosive growth. And I think liquidity mining will be here. I don't know how long it will be here. Like if a new lending platform opened up tomorrow that had liquidity mining, I don't know that it would have found the level of success that these are. And I think Balancer, even though it's had a pretty hefty valuation in the VC market. I think it was like 30 million post money. Don't quote me on that, but like I think Balancer will be a good test case to see whether if the price persists and will it live up to the hype in 3, 6 months, 9 months, a year. We'll see. But it's not new. It's just a new wrapper.
I like that. No, it definitely is. We have mining, gen mining, liquidity mining, yield farming. It's like different words.
Yeah.
And so, Hassan, switching over a little bit, I don't want to keep you too long, running out of time, but I want to get some quick questions in for you.
No problem, bro.
So, I mean, obviously, DeFi, yield farming, like it's sucking all the energy out of the space, and you still have a lot of really high valuation layer ones in the market in the top 10, which I don't think should be there. But they're obviously like ghost chains. It wouldn't take a lot to move their price on a sell order. What are you guys thinking there? Like, is that a potential trade for you? Go short some of these dead projects, long some of the lively ones, or is it just too hard to short things in this market?
No, it's not. It's not too hard to short like the large caps. Especially with some of the desks that do a great job working with us, like Genesis and Coinbase and B2C2 and all these great places. Like, sorry for the ones I named, but we just think like like large caps are it's just a different flavor of beta, right? It's just a different flavor of beta. And depending on what we want our Bitcoin beta adjusted balance sheet to be trading at, like, we'll think about it that way. So like, interestingly, like, Ripple and Stellar, highly correlated, right? So for some weird freaking reason,
well, it's because Jed owns both.
Yeah. So therefore they must
kidding.
be the same. Yeah, they do. Yeah, exactly. So like, if you want to like hedge out the beta and try to generate alpha, if you think Stellar's going to have outperformance, actually that would have been a great trade. Long Stellar, short Ripple, pretty much from the start of the year is a great trade. So we think about it like that. Like, I mean, like Tron V4 is coming out eventually. And if you think that Justin Sun's going to hype it, you could just long into it and then short after it. But like, it's tough to short in this market.
Yeah.
If you don't have something as a backstop, if you're not hedged.
But I mean,
short's pretty tough.
But your ETH trade is pretty solid, though. I mean, because your ETH trade it really doesn't matter if you have 2 launches. Well, I mean, it does matter to price a bit, but you know what I mean?
Yeah. Because that trade's a nice trade because we are literally just trying to capture the premium. And, when I presented that idea, it's like, I know that the price on ETHE right now is fake. You know what I mean? There's like, I think the float at the time we had it was like, I think like 300 or 400, maybe 500,000 shares were in the float. And I also like have the unlocked schedule. So I know what people are going to be doing. And so you work backwards and you use a comp. Like, okay, so like GBTC, what was the premium of GBTC at the stage in the life of ETHE when we would unlock, right? So is it a year and a half in? So what was the premium of GBTC a year and a half into its life? Okay, is that a good barometer? Yes, maybe no. You obviously have to compare like the AUM and the NAVs and things like that. It was obviously a different time too. Like,
and no one was looking. You could compute the percent of people or percent of share that would have withdrawn on GBTC at the same time that you guys are going to withdraw on ETHE.
Yeah. So I mean, there's always ways to think about it. But like, look, I don't expect ETH. I would love ETHE to be at 100% premium in a year. I would love that. That would be very good for our trade.
Yeah.
Considering the size. Yeah. But base case, we're modeling, 35%. Anything over 50, 60% is gravy. And, you're doing it on volume. So it's nice. 35% of a big number is pretty nice.
Oh yeah. No, trust me. I'm with you there. Other last minute questions for you. How, and this is way deeper question. We probably need more time on this, but how important is token econ and value accrual to you guys? Because I know we've been talking a lot about trades and hype and momentum, but I mean, it's clearly important to us. I'm wondering what you guys think.
Yeah, no, I think you guys do a great job. Like, I really do. Like, every idea I have or every like thing I look at in regards to token economics and structuring a token and things like that, I run it by or try to run it by Jan and you and like Medeo and everyone there, like, because I think you guys are the best in the space. And even
appreciate
Paul now, that. I'm shilling Paul now too.
We got to get Paul out there. Appreciate that.
Paul, Paul, Paul. You know the token. All right. So basically, So I think it's very important, especially for these micro caps and these small caps, because really what you want to do, and it comes down to like 3 things in my opinion, is 1, incentivizing early financial speculators with high inflation. 2, creating a secondary market with or not creating, but like generating a secondary market interest in the token that has nothing to do with the early financial speculators that are staking it and earning that yield. And the 3rd is generating demand on the buy side, separate and apart from the secondary market that you've developed. So what I mean by that is like, you want, you're staking, you're getting high inflation. That's balanced with generating, like being able to supply tokens to the secondary market, like on exchanges, like a small float, right? And then 3rd is educating the market on the token so that they want to buy the token. They want to come. And the reason for that is it has nothing to do with like increasing the token price. Maybe those people that you educate the market on, maybe they want to become stakers. Maybe they want to buy the token in the secondary market. Maybe they want to do a little bit of both. But the point is, you're growing the community, and the growth of the community is not just financial speculators, but people that are learning about it. And it's kind of like a network effect, and like very loosely, like you're marrying early financial gains with secondary market growth plus new community members that are learning about it. And there's an elegant blend in there. And if you find it, like the feedback loop is positive, and you can have ridiculously good runs like, SNX, hopefully Rune, a few other ones like.
But what you're saying though is it's not easy to find. Like, I mean,
of course not. Yeah.
I mean,
90% of these things are going to fail.
Yeah, no, what you're describing is you not only need the token econ correct for each of those three buckets, but you need to make sure that all three of those buckets are acting in a way that grows the community. I mean, that's hard. Like, what if the early stakers sell, or what if the second people don't want to become stakers? Like, it's tough.
Yeah, no, it's very tough. And that's why you have to be totally in line with the team. Like, this is the new crypto VC in my world. This is like a nice shift in what we've seen. It's like funds like of our size, like under 100 million, that are working directly with the team on every facet of the project. And where we don't know, like obviously we're not devs, so we're not coders or engineers, but where we don't know something, we'll work our sources to bring in someone that has an answer that can help. And so we work on the token economics. We give them feedback. We give them a feedback on the liquidity roadmap. Like, if everyone in the token is staking it and there's no secondary market, what are you doing about that? Have you thought about seeding a Uniswap pool and putting a certain number of project tokens in there and a certain number of ETH and letting the market choose? Are you thinking about putting it on other DEXs? Are you having AMAs? Are you bringing in other people that are looking and thinking about the token? Like, have you thought about how big the supply needs to be, how big the inflation needs to be, like how big the lockup needs to be, and how long the rewards will be until they're distributed? Things like that. So yeah, it's hard, man. It's freaking hard.
A lot goes into it, man. But you know what? It's a drug, man. When you find one that hits, it's all you want to do.
Totally. And you could definitely crypto, VC investing in crypto is becoming more efficient. The market's getting smarter in the sense you are finding good projects, and other analysts are finding good projects too. And it's not just by we're a layer one, we have 100 billion tokens. Tokens are issued for 10 cents. Therefore, we're a $10 billion market cap. You know what I mean? So
those days are over.
It's different. Those days are over. Anybody that said making money in crypto these days is easy is wrong. It's a lot of work, and there's very smart people in the space. Yeah.
No,
so I'm happy to be a part of it.
No,
yeah.
that's incredible. And Hassan, last question for you. Definitely can't wait to have you on again soon, by the way. I got to break this up for people that need to get back to work.
For sure. Yeah.
But last question. I mean, you deal with institutional investors all the time. What, you're actually on the front lines of this. You're not just like an armchair Twitter guy, screaming about it. Are people actually coming into the space from the institutional side or not?
Yeah, we've seen from us personally. So we have two structures. We have the hedge fund, and we have the GP we have a operating company, which is also the GP of the fund. We are seeing a lot more interest from both institutions, both as LPs directly into the fund and as equity investors in the operating company. And the operating company, So it's a blend, right? Because obviously institutional investors on the fund side, they just want to be exposed to the digital asset space in trading from trading perspective. But on the investment side, or on the opco side, we're issuing blockchain wrap products soon. That's the goal of the company, is to issue SEC regulated blockchain wrap products. And so they want exposure to that too. And the institutional interest has definitely picked up. And I can attest to that both from an AUM perspective and an equity value perspective. So yeah, it's coming. It's slow. These things take time. It's not these guys do years of research on Bitcoin. People on CT were talking about how Paul Tudor Jones is going to go on onto Bloomberg so that he can dump his Bitcoin bags on traders trading the announcement. And it's
my God.
It's I hate you guys, man. You think these guys are doing literally 3-4 years of research to dump a position after a month? You guys don't know. It's just
for guys that rich, it's not worth the headache. It's not worth it.
They're not doing it for this. They do years. It's just it just shows you how disconnected CT is from traditional institutional investment level finance.
Hey
It's
man,
funny.
I love crypto Twitter,
CT.
man. I love it. I love it to death.
I love CT too. This is not denigrating CT. I'm just saying, like, when you read stuff like that, you realize like both institutional investment's going to come, but we also have to grow up, and we're going to do both, and everything's going to be fine. I believe that.
The people coming to you, are these people that are already invested that are saying, hey, you guys crushed it, we want to double our investment? Or is this new people, or is it a mix?
We've had follow-on from our early investors, and and we have new feedback every day from new I guess you could say new leads, new people come to us. And I think for Arca, like, we're having a really good year. I think I don't think I'm allowed to say the returns, but like, we're having a very, very good year, and hopefully that stays. But like, I think in general, when people come to us, it's a combination of you're doing everything the right way and the returns are good. I don't know that people would be coming to us if the returns were bad, but we're doing everything the right way. But doing everything the right way, doing it on a regulated front, it's necessary but not sufficient to bring in the capital. Some law school speak. But like, the returns are, I think, in my opinion, both sufficient. You need them both. They're necessary to get the money in the door.
Hassan, I cannot wait to use the line "necessary but not sufficient." I am waiting for my flood there.
Necessary but not sufficient. Like, it's necessary to do things the right way, but it's not sufficient to bring the money in the door. Because if you're doing everything the right way and just losing money, like, you're destroying value. I don't know who wants to come in, but yes, I mean, yeah. That's, Tom, you could take the LSAT now that you know.
Now I'm ready to go, man. I started the CFA, man, and I quit my job after I passed level 1. So if that kind of a similar story there. But Hassan, incredible having you on, man. Down to earth, straight to the point. I love it. Where could people learn more about you and Arca?
Yeah, so you should go to Arca. The website is www.ar.ca. It'll take you there. And then for me, I'm on Twitter at Hassan Bassiri, I think. At Hassan Bassiri. Yeah, that's just first and last name. I'm still like wading into the CT pool. Like, I'll respond to tweets if I'm asked, but I just don't like to. I don't like to share alpha, bro. Like, I get paid for that, so.
That's a good reason, man. That's a very good reason. Yeah. Well, everyone listening, scroll down, check out Arca's site, follow Hassan, and ask him some crazy questions so he could share some alpha with you guys.
Yeah. Love to shill all day.
Hassan, great having you on, man.
Thanks, Tom. Talk soon, bro.
Hey, everyone. Thanks for listening to the podcast. If you enjoyed it, please support the show by hitting subscribe on iTunes, writing a review, or sharing this episode on Twitter and LinkedIn. And stay tuned for our next episode, out soon.